Today I was at work and I was checking my stock portfolio and I was looking at some of the companies on my watch list after hours. One of them was Meta. It was down about 3% after hours and it's down about 3.6 in the after hours as of the time of me filming. And I thought, that's weird, and I didn't think too much of it. Until I got to Google and I said, my company, one of the companies that I own, Google, is down 1.7%. What's going on? What's causing this? Those of you that follow me know that of the four companies I own some Google stock. It makes up about 13% of my portfolio. So I said, why is Google down about 2% in the after hours? And I didn't figure out why until I see my phone blowing up with notifications that Snapchat just got cut in a fourth. It was down 25% plus. As of the time of me filming, it's down about 27% in the after hours. We're going to talk about what went wrong for Snapchat, why I don't think that this is a company that is one that's worth investing in. There is some good news from this report, but generally speaking, the overall sentiment of the company, the lack of revenue growth, the free cash flow negative growth that it's experiencing, and then the huge restructuring with 6,000 employees being laid off, it just overall, in my opinion, is not the type of company I want to be in. And don't get me wrong, this company's had pretty good revenue growth over the last several years, but it's finally coming to a halt, and I don't think we're going to see much better past this point. So if you're interested in Snap stock, if it's a company you're interested in investing in, I think this is a quick bullet point video for you that you'd like to see that could give you an overall perspective that is an unbiased opinion from someone that does not own the stock and will give you an honest, truthful opinion. If you haven't seen me before, my name is Jordan. I'm a millennial investor. My portfolio as of the time of me filming is about 40,000, and here's my performance so far since joining this brokerage. If we hop over to my portfolio tracker, here's my performance since starting YouTube back in 2020 on a month-over-month basis every single month. And here's my portfolio holdings, which I already showed. My performance updated every single month, and it shows year-to-date where I'm at 2022 versus the four major indexes. And then my monthly and lifetime YouTube income is shown right here. If you want to check out these portfolios, if you want to see my investments, you can check these out down below in the description within One Finance, and you can get $10 for getting signed up. So check out all the stuff down below in the description. But other than that, let's go ahead and jump straight into Snapchat, and let's look at first off the top line revenue growth. The reason why a company like this exists, and the reason why you'd even want to invest in it, is the revenue growth. So let's look at the revenue growth, okay? You see that for several years, all the way when this chart started back in 2016, all the way up until about 2021, this was a pretty high grower. If you look over the last 5 years, it's grown a compounded rate of 40%. 2 years over 29%. But in the last year, as of the most recent quarter, their quarter that was just reported today, it only grew 5%. 5% is a long shot from the 5-year average of 40%, and the last quarter wasn't much better either. But for me, someone who cares about profit, someone who cares about capital that can be returned to shareholders, the free cash flow is really what's important here. And look at all these negative years of free cash flow. They've started to get the losses underhand, and they've started to put up some profitable quarters, but what little profits are left are being eaten away by this recession. Profits are down 65% year over year, and the free cash flow is so marginable that it's basically non-existent. And so when I look at this company, I already know right away that the main reason you would want to own a company like Snapchat is you believe it's going to be a big grower. People are going to use the platform, the revenue and profitability for the company will expand, but when it's only growing 5% in a recession, that's not good. Let me give you an example of a company that you want to own in a recession, in my opinion. My largest investment is Salesforce, even though despite this horrible recession in the most recent quarter, they're growing 21.77% as this beautiful revenue chart gets better, and then the year-over-year cash flows continue to hit record levels despite the recession will continue to grow. Companies like Snapchat, in my opinion, do not have comparable moats compared to companies like Meta or TikTok, especially TikTok, and I don't think that this 5% revenue growth may even stay in the positive. I think that there's a fairly good chance that this company could see revenue growth go into the flat or even negative territory. So let's jump into Snap earnings. It dropped 25% on the announcement of its third quarter earnings, and the thing is that this company's earnings per share and its revenue estimates weren't even really that bad. Its EPS, which is basically its profitability, its measure of net income, was pretty much right in line what people expected, and its revenue was almost exactly, basically in line what analysts were expecting, and daily active users, which is a big part of Snapchat, actually beat expectations. Analysts were expecting 358.2 million. The company reported 363 million, about a 5 million daily active user beat, which is pretty good. However, the negative part comes from this section. Daily active users increased 19% year over year, showing the company is still able to attract people to the service despite the struggles on its business side. Average revenue per user, or ARPU, was down 11% to $3.11, which basically means as they're gaining customers, unfortunately, despite this recession with advertisers not willing to pay as much, it is down 11% what the average advertiser will pay for each user that's on the platform. In August, Snap announced that it would lay off 20% of the company's 6,000 employees as a part of its major restructuring plan. And I think this is the big issue that investors are having with this company. You have revenue growth, which is flattening out, only 5%, not anywhere near what this company used to do. You also have profitability. Its free cash flow is so low that it's basically non-existent. We have $18 million with an M versus an $18 billion market cap. The free cash flow was literally 0.1% the size of the market cap, and I don't think it's going to be hitting all-time highs or growing much in the future. If you're a Snap shareholder, there was one bright spot this quarter, and you can read over this. I won't go over it thoroughly, but basically the company is announcing a $500 million share buyback program, which the good news is this $18 billion market cap is going to be going down dramatically as of tomorrow with this 20, 25, 30% drop. Who knows where we'll end at tomorrow. But basically, I would guess that after tomorrow's drop, this company's share price is likely going to be somewhere around $13 billion. And considering that the company announced a $500 million share buyback, that's pretty substantial given the circumstances. If this company is, for example, buying back $500 million worth of shares and the company's market cap, say, trades at an average of $13 billion, then that means that they'll be able to buy back almost 4% of the company's shares outstanding. And this leads me to another negative of the company. Let's talk about the cash and the shares outstanding. If you look at this cash pile, it looks pretty good. Ever since about 2019, the cash pile has been growing from about a previous $1 billion up steady to 2 to 3, and now up to an almost $5 billion in cash. And that looks great. However, there's a caveat. If we pull up the debt pile, the only reason this cash pile has been going up significantly is because the debt during that same time went from 0 all the way up to $3.7 billion. So basically all of this cash increase, all of this money, this influx of cash has not come from the company generating profits. It's actually come from them just taking on more and more debt, which obviously has to be paid back sometime. And of course, cash can only be generated from free cash flow positive companies, and that's why this company has never really bought back shares until 2022. And you can see over the last several years since this company went public, they have been issuing a ton of shares. Over the last 5 years, they've been growing shares outstanding by a 5% growth rate. That is not good. That dilutes your ownership. The amount of shares outstanding, the more slices in the pie per se, the slices of the pizza, whatever you want to call it, has been growing by 5% every single year over the last 5 years, over 5% to be exact. And that even includes this most recent quarter going down. So it's actually probably closer to 6%. Now, if you look at this, it's finally starting to trend downwards, and I will give management props to this. The one benefit I will say is that if you look over the last several years, if there was a time to be buying back Snap stock, it's not when it's at $75. It's not when it's at 50 or 20 or 30. It's now when today's share prices are near $10 or even less based on where we're going to be at tomorrow. This company will likely be trading at around $7. So if there was a time to buy, the time is now. But the thing is, when I look at my companies that I own, I look at companies that are profitable, that are growing, that are defensive. If you look at every single one of these, the one risky play I have in my portfolio is Crocs. But if you look at every other big name in the portfolio, they are all extremely profitable and extremely defensive. And I would say that would even include Google. Google is down after hours off the back of this earnings because they are a big advertiser, but at the end of the day, I see a company like Google having a way bigger moat than a company like Snapchat. So if we go to M1 Finance here and we type in SNAP for Snap and we look at their stock, this is why this company's 5-year performance is at a 28% negative performance, and Google is at a positive over the last 5 years of 103%. Now, it's not just because people like Google more, and it's not just because of the moat, quote. But in the same way, if you look at the last year, this company grew revenue 5.7%, which is not good. Meanwhile, Google, which is already a giant, it's a conglomerate of search engines and other tech platforms, you can see that even this, despite the recession, this company is still growing at 12.6%. It is growing over double what Snapchat is, and I think that it is likely that this will continue. With all of its growing categories and all the businesses that it keeps buying out, I think we'll eventually see in a few short years this company doing $100 billion plus in revenue, and of course, the billions, the tens of billions of profits that this company produced will continue to be skyrocketing over time and will produce lots of value to shareholders, which is why you see the opposite from what Google does. You see a growing cash pile without raising really any debt whatsoever. The cash versus the debt is so negligible you can't even really see it. It's basically all cash, and then the shares outstanding. This company has been buying shares since about 2018 on a consistent basis, quarter over quarter, and they just announced a $70 billion buyback program. So while this buyback program may look good for Snapchat, the underlying business, which is what you should really care about as an investor, is negligible. It's not one that I want to be invested in. It's not one that I like. And while I do like the product, when I was in high school and college even, I used Snapchat a ton. But now as an adult who's married that doesn't really care about the platform, I see many other people moving away from it and joining something like a TikTok. So stay away from Snapchat in my opinion. Don't follow me. Do your own research, do your own due diligence, and make your own opinions. But for me, this is not one I'll be investing in really at pretty much any price, unless the price were just to get so ridiculously low. I don't know, just something crazy like $1 or $2. It's not a company I'd ever really consider investing in. But other than that, guys, thank you so much for watching. Check out all the stuff down below in the description. Help support me in the channel and get $10 for getting signed up with them on finance. But other than that, guys, thank you so much for watching, and I'll catch you guys next time.